If you are on Social Security right now, or if you are within 10 years of claiming, there is a very real chance you are leaving money on the table this year. And most of you watching have no idea, because the Social Security Administration does not pick up the phone to tell you. Before I go one sentence further, I need to address the single biggest misunderstanding about a video like this one, because it is the reason most people click away before they hear what actually applies to them. People assume that an urgent Social Security warning is only relevant to one specific type of retiree. Either they think it is exclusively for people in their 70s and 80s who have already been collecting for years. So if they have not started yet, they tune out. Or they think it only addresses claiming decisions. So if they are already in their 60s and already locked into their benefit, they figure it has nothing to do with them anymore. Both assumptions are wrong. I want to be completely clear right now. Whether you were born in 1943 or in 1972, whether you are already collecting or you are still a full decade away from filing, there is real money on this list with your name on it. The rules are different for every birth year, and the mistakes that quietly cost you the most depend on precisely when you were born. I am going to tell you, on every single item in this video, exactly who it affects and how, so that nobody watching can say with confidence that this does not apply to them. Because the honest truth is this: retirees at every age are quietly being paid the wrong amount, or quietly being charged the wrong premium, or quietly being taxed on a check the government already taxed once when you were out there earning it, and the majority of them will never know unless someone takes the time to explain it. The reason almost nobody warns you is the same reason it always comes down to. Every party who benefits from your confusion has a financial reason to keep quiet. The Social Security Administration does not call to tell you that you may be on the wrong benefit, or that a brand new law just put thousands of dollars in retroactive payments into the hands of people who look exactly like you. Medicare does not call to tell you that the premium being pulled out of your check every month may be hundreds of dollars higher than what you actually owe. The Internal Revenue Service does not call to remind you that the rules for taxing your Social Security were written in 1983 and have never been adjusted for inflation a single time in the 4 decades since, which is precisely why a check that was completely tax-free for your grandparents has become taxable for you. So, in the next 25 minutes or so, I am going to walk you through what just changed in 2026, group by group, plus the one tax issue that almost nobody covers, and that quietly costs the average couple thousands of dollars every single year. Here is the central idea that connects everything. Being owed something and actually receiving it are two completely different outcomes in this system. The law does not automatically refund you. Nobody mails you a check. You have to know the rule exists, and then you have to go claim it. That is the entire reason this video exists. My name is Marcus Graves. I am an enrolled agent, which means I am federally licensed to represent taxpayers directly before the Internal Revenue Service. I sit across the table from the IRS on behalf of real people every single day, and a significant portion of the people I work with are seniors, retirees, and people who are approaching that stage of life. The most painful pattern I see, over and over without exception, is not people trying to work the system. It is honest, careful people in their 60s, 70s, and 80s paying bills they never owed, missing payments they were absolutely owed, and making one-time claiming decisions that permanently lock them into the wrong number for the rest of their lives, simply because no one ever sat them down and explained what their specific rules actually are. That is the most expensive kind of mistake there is, because it is invisible. There is no notice in the mail. There is no penalty. There is just money quietly leaving your account every single month, or money you were owed that simply never shows up. Let us fix that right now. I am going to start with the single biggest change in 2026, because this one alone has already put real money into the hands of millions of retirees in the last several months. And a lot of you have a deposit sitting in your account right now that you do not even know to look for. Then we go group by group and stay until the end, because the final section on the tax that quietly eats your Social Security check is the one almost no other video on this subject will ever tell you about. The biggest 2026 change, the Social Security Fairness Act. The most important Social Security change in decades is a law called the Social Security Fairness Act. It was signed into law in January of 2025, and it does something the federal government has not done in over 40 years. It repealed two long-standing rules, the windfall elimination provision and the government pension offset, that for decades had been silently cutting Social Security checks for millions of public sector retirees. If you spent any meaningful portion of your working life as a teacher, a firefighter, a police officer, a federal employee under the older retirement system, or in any public sector job where your employer did not withhold Social Security taxes from your paycheck, those two rules had probably been quietly reducing your Social Security benefit. In some cases, they had been erasing it entirely. They are gone now. The repeal is retroactive to January of 2024, which means the Social Security Administration owes lump sum back payments to roughly 3 million people. Some of you watching have already had a deposit land in your account in the past several months and genuinely did not know what it was for. Some of you have a payment on the way that has not arrived yet, and nearly everyone affected is also owed a higher ongoing monthly benefit going forward, somewhere between approximately $360 and well over $1,000 more every single month, depending on the type of pension you hold. Here is exactly what to do this week if you think this might apply to you or to someone in your family. Log into your My Social Security account at SSA.gov. Look at your recent payment history. If there is a lump sum deposit somewhere in 2025 that you cannot account for, that was your retroactive back pay. If you do not see one, and you ever held a public sector job that did not deduct Social Security taxes, call the Social Security Administration at 1-800-777-21213 and ask specifically about the Fairness Act calculation. Do not just ask whether your benefit is correct. The representative will tell you, yes, your check is correct as it currently stands. And that will be technically true under the old calculation. You have to ask about the Fairness Act by name, because that is the specific file they have to open to locate your situation. The information is already in their system. You just have to ask the right question to unlock it. Group 1, born between 1943 and 1954, ages 71 to 82. Your full retirement age was 66. You have been collecting for years, and almost everyone in this group assumes there is nothing left to examine or question. That assumption is exactly what costs people in this group the most money. There are 3 things I want you to verify this week. First, are you collecting the right benefit? This matters most if you are widowed or divorced. If you lost a spouse, the Social Security Administration is supposed to compare your own retirement benefit against your survivor benefit and place you on whichever one is higher. The survivor benefit can be up to 100% of what your late spouse was receiving, which in many cases is meaningfully more than what your own record produces. If you are divorced after a marriage that lasted 10 years or longer, you are also eligible to claim on your ex-spouse's record up to 50% of their benefit, even if they have remarried, even if you have not had contact in 30 years. The Social Security Administration does not automatically run these comparisons for every person. You have to call them at 1-800-772-1213 and use these exact words. Compare both benefits, including the divorced spouse option if it applies, and put me on the higher one. That one phone call, for a lot of widowed and divorced retirees, is worth hundreds of dollars every single month for the rest of their lives. Second, verify your Medicare Part B premium for 2026. The standard Part B premium this year is $185 per month. If your premium is significantly higher, somewhere in the $300 to $500 range, you are paying what is called an IRMAA surcharge. It is calculated based on your income from 2 years ago. If your income has dropped since then, because you fully retired, because a spouse passed away, because you sold a property in a one-time event, or because you stopped taking large IRA withdrawals, you can appeal that surcharge. The appeal form is the SSA-44, and it exists specifically for retirees whose income dropped due to a qualifying life-changing event. People pay that elevated premium month after month, year after year, without realizing they have the right to fight it. One form filed correctly has put thousands of dollars back into the pockets of people I have worked with personally. Third, the Fairness Act. If you ever held a public sector job that did not deduct Social Security taxes from your paycheck, and you have not specifically called the Social Security Administration about the Fairness Act since it passed, this week is the week to make that call. Group 2, born between 1955 and 1959, ages 67 to 71. This is the most consequential group of all in 2026 because the rules in this specific age range are different for every single birth year, and most people in this group do not know their precise number. Here is the complete full retirement age breakdown. Find your specific year. Born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, 66 years and 4 months. Born in 1957, 66 years and 6 months. Born in 1958, 66 years and 8 months. Born in 1959, 66 years and 10 months. That is your number, not around 66, not 67, your specific month and year. Why does this matter so urgently right now? Because people in this group are making, or have just made, their claiming decision. And the difference between getting it right and getting it wrong is permanent. Let me put real numbers on this. If you claimed at 62 with a full retirement age of 66 and 6 months, meaning you were born in 1957, your monthly benefit was reduced by approximately 25.8%. That reduction stays for the rest of your life. On a $2,000 monthly benefit, that is $516 less every single month forever. Over 20 years of retirement, that is more than $120,000 in lost income you never recover. The Social Security Administration does not warn you about that figure before you file. They process your application, you sign, and the reduced number becomes your permanent benefit. If you are in this group and you have not yet filed, the math runs powerfully in the other direction. Every month you delay past your full retirement age earns you an additional 2/3 of 1% permanently. That compounds to roughly 8% more for every full year you wait. Between your full retirement age and age 70, you can accumulate anywhere from 24% to 32% more per month for life, depending on your exact birth year. On a $2,000 benefit, that is potentially $640 more every single month, permanently. If you can afford to wait, every month of delay is a genuine compounding raise for the rest of your retirement. There is also one tool available to this group that almost nobody uses, and it can be worth a lump sum of up to $12,000 in cash the day your first check arrives. It is the retroactive lump sum option. If you apply for Social Security at any point after you have already passed your full retirement age, you can ask the Social Security Administration to backdate your claim by up to 6 months. They will pay you as if you had filed up to half a year earlier, in a single lump sum payment delivered with your first regular check. On a $2,000 monthly benefit, that is a check for up to $12,000. The trade-off is that your ongoing monthly amount is slightly reduced because your effective start date moves back. But for people who need cash coming in right now, that option is sitting right there in the rulebook, and almost nobody ever asks for it. You have to specifically request the retroactive lump sum at the time you file. No one at the Social Security Administration will bring it up unprompted. And finally, if you are in this group and you are still working while collecting Social Security before reaching your full retirement age, the earnings test is going to affect you in 2026. If you earn more than $23,400 in a year, the Social Security Administration withholds $1 of benefits for every $2 you earn above that limit. The money is not permanently gone. It gets credited back to your record once you reach full retirement age, and your monthly check is recalculated upward to make you whole over time. But if you do not know this rule, that withheld money feels like your check simply disappeared without explanation. Knowing the rule is the difference between panic and patience. Group 3. Born between 1960 and 1965, ages 60 to 65. For everyone in this group, full retirement age is exactly 67. And right now, The most important decision in front of you is when to claim. Most people are about to make that decision wrong by treating it as a one-dimensional question when it is actually two-dimensional. Here is the part most videos completely miss. Claiming at 62 with a full retirement age of 67 reduces your monthly benefit by 30% permanently. On a $2,000 monthly benefit, that is $600 less every single month for the rest of your life. Over a 20-year retirement, that represents roughly $144,000 in cumulative lost income compared to waiting until 67. The Social Security Administration processes the early claim without warning you about that specific number. They ask if you understand your benefit will be reduced. You say yes. The smaller number becomes your permanent reality. But here is the wrinkle that nobody talks about. And this is where it stops being purely a Social Security decision and becomes a tax decision too. When you claim matters not just for the size of your monthly check, but for how much of that check the IRS takes back afterward. Those are two completely separate calculations, and almost nobody in this group runs both of them at the same time. If you claim early at 62 and you also have a pension, an IRA you are drawing from, dividend income, or a part-time job bringing in income, you can end up in a situation where as much as 85% of your Social Security check becomes federally taxable. So your already reduced check gets reduced again, this time by the IRS. Which is why, for many people in this group, the smartest move is not just to wait before claiming, it is to actively use the years between 60 and 67 to move money out of traditional IRA and 401k accounts into Roth accounts, so that when you do eventually start Social Security, the rest of your retirement income is not pulling your check into a higher taxable band. I am coming back to this in detail shortly, because it is the single biggest tax mistake retirees make, and almost no one explains it to you before you file. There is also a small but valuable claiming rule available to this group that virtually nobody discusses. If you reach your full retirement age of 67 and then wait a few additional months before filing, you can request up to 6 months of retroactive payments at the moment you apply. The Social Security Administration pays you as if you had filed up to 6 months earlier, in a single lump sum on day one. On a $2,000 monthly benefit, that is up to $12,000 handed to you with your very first check. You just have to ask for it. And for those of you in this group who are still 5 or 6 years away from filing, the single most valuable thing you can do this week is verify your earnings record. Log in to your My Social Security account at SSA.gov and pull up your Social Security statement. Look at the earnings listed for every year you have ever worked. Compare them against your own records, old tax returns, W-2 forms, pay stubs if you still have them. One incorrect year, an employer who submitted the wrong amount in 1995, a freelance year that never got properly recorded, a job at a company that closed and lost its payroll records, reduces your monthly benefit by approximately $100 per missed year for the rest of your life. Find the error now, while you still have time to correct it and while the documentation still exists. Do not discover it the month after you have already filed and locked in your permanent number. Group 4. Born in 1966 or later, age 59 or younger. You are not close to claiming Social Security yet. And that is exactly why what I am about to tell you matters more, not less. Because the window to fix certain things without it costing you money is still wide open, and it will not remain open indefinitely. Your full retirement age is 67. Claiming at 62 means a 30% permanent reduction. Waiting until 70 means up to 24% more than your full benefit, permanently. Those numbers are locked in by statute. What is not yet locked in is whether your earnings record is accurate, and verifying that record is the single most valuable thing this group can do right now. The Social Security Administration has been recording your payroll data since your very first job. That information came from your employers, and in every single year, there was an opportunity for something to go wrong, a number submitted incorrectly, a year missed entirely, a period of self-employment that did not get reported accurately. Each uncorrected error reduces your eventual monthly benefit by roughly $100 per missed year, and that reduction lasts for the entirety of your retirement. If you worked through the 1980s or 1990s, the era of manual payroll processing, there is a genuine chance your earnings record has at least 1 year that does not accurately reflect what you actually earned. The correction process is straightforward, but it requires documentation, W-2 forms, pay stubs, old tax returns. Those things become harder to locate with every passing year. Right now, 10 or 15 years before you claim is the easiest moment in your entire life to make this fix. In another 15 years, those records may be gone and the correction may no longer be possible. Here is the exact process. Go to SSA.gov, log into or create your My Social Security account, and open your Social Security statement. Scroll to the Earnings Record section. It lists every year you worked and the amount that was reported. Compare that list against whatever documentation you have year by year. If anything looks wrong, file a request for a correction of earnings records, submit your supporting documents, and the Social Security Administration processes the update permanently. Do it now, while the paperwork still exists and while the fix costs you nothing but a few minutes of your time. One more thing for this group, because you are going to hear a lot of alarming noise about it. The Social Security Trust Fund is projected to face depletion around 2033. Here is what that actually means. If Congress takes no action between now and then, the program would only be able to pay approximately 80% of currently scheduled benefits from ongoing payroll tax revenue. That is not the program disappearing. That is a potential benefit reduction, if no legislative fix is made. Historically, Congress has acted before every previous funding shortfall. Plan for the program to still exist, but also plan as though your personal retirement accounts are doing the heavy lifting. That is the honest, grounded answer. The part no other video will tell you the tax bomb sitting on top of your Social Security check. Here is the issue, and it makes most retirees genuinely angry the first time they hear it explained clearly. The federal government taxes your Social Security benefits. Not for everyone, not in every circumstance, but for most retirees who have any other meaningful source of income at all. And the income thresholds that determine whether your Social Security gets taxed were written into law in 1983. They have not been adjusted for inflation a single time in over 4 decades, which means thresholds designed to apply only to high-income retirees in 1983 now apply to almost everyone, because a perfectly normal retiree today, with a normal pension and a normal IRA distribution, is now sitting above numbers that used to only affect wealthy households. Here is how it works in plain language. The Social Security Administration calls it your combined income, also referred to as your provisional income. It is your adjusted gross income, plus any tax-exempt interest you earned, plus half of your Social Security benefits. Add those 3 numbers together, and you have your provisional income. Now compare that total to the thresholds, which have not moved since 1983. If you are single and your provisional income comes in below $25,000, or married and below $32,000, none of your Social Security is taxable. None of it. If you are between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, up to 50% of your Social Security becomes taxable. And once you are above $34,000 single or $44,000 married, up to 85% of your Social Security is taxable at your ordinary income tax rate. 15% of your benefit is always tax-free regardless of income, but the other 85% of every check is potentially on the table. Let me put a concrete example on this. Picture a married couple receiving $2,500 per month from Social Security plus another $4,000 per month between a pension and IRA withdrawals. They are sitting well above the $44,000 married threshold. 85% of their Social Security, roughly $2,125 per month, becomes taxable at a 15% effective federal rate. That works out to approximately $318 per month, flowing right back to the IRS out of a check they already earned, every single month for the rest of their lives. That same couple 20 years ago would have been under the threshold and paid nothing. The thresholds have not moved. They have moved into the thresholds simply by having a normal retirement. There are 4 legal strategies retirees use to push back against this. Let me give them to you clearly. Strategy 1. Execute your Roth conversions before you start collecting Social Security. Distributions from a Roth account do not count in your provisional income calculation, but distributions from a traditional IRA do. If you spend the years between 60 and 67 gradually converting traditional IRA money into Roth, you permanently lower your future provisional income and keep your Social Security in a lower tax band for the rest of your retirement. Strategy 2. Use qualified charitable distributions if you are over 70 and a half and you give to charity. A QCD is a direct transfer from your IRA to a qualifying charitable organization. It counts toward your required minimum distribution, but it does not appear in your adjusted gross income, which means it does not elevate your provisional income, which means it does not pull more of your Social Security into taxability. You can do up to $108,000 per year this way. For anyone over 70 and a half who is already giving to charity, routing those gifts through your IRA instead of your checking account is one of the highest leverage tax moves available anywhere in the retirement planning toolkit. Strategy 3. Be strategic about when you realize capital gains in years when you are also collecting Social Security. A large one-time capital gain pushes your provisional income upward, which can drag up to 85% of your Social Security into taxability for that entire year. If you have any flexibility, consider spreading large gains across multiple tax years rather than realizing them all at once. Strategy 4. Check your state's current rules on taxing Social Security. Most states no longer tax Social Security benefits at all. A small number still do, but that list has been getting shorter every year. Even if your state taxed Social Security in the past, it is worth verifying the current rule. For people who have genuine flexibility about where they live later in retirement, a state change can be worth thousands of dollars per year on Social Security income alone.